I hope you're all well this morning and thank you for joining us today. Um, as we get started into this in conversation session today, my name's Kathy Ramsey. I'm the Membership and Business Operations Manager here at the Tourism Industry Council of South Australia. First, I'd like to acknowledge I'm hosting this webinar from the lands of the Kaurna people. I'd also like to acknowledge the traditional custodians of the various lands where you all join us from today and the First Nations people participating in this webinar. I'd like to pay my respect to elders past, present and emerging and celebrate the diversity of First Nations people and their ongoing cultures and connections to the lands and waters of South Australia. Our In Conversation webinar series these short webinars are part of our business development program, where we really provide opportunities for tourism operators like yourselves to gain insights and advice with business planning and operations. I really like to try to keep these sessions a conversational style, so I really encourage you all to ask questions and take full advantage of the experts on hand today. Whilst I'll be asking some questions, please feel free to use the chat function I can use the chat functions through this webinar and I can then pepper them through our session, but we also leave enough time at the end for a bit of Q&A. A little bit of housekeeping, if we could just ask everybody to keep their microphones on mute, that will help the technological and the performance side of this session today. And for everybody's information, this session is being recorded and it will be distributed to all registered attendees afterwards. So we are really lucky to be joined by BankSA and Hood Sweeney for an economic update, followed by some cash flows, tips and tricks, forecasting on how to forecast with the current climate. So let's get ready to empower yourself, and I hope you all feel like you can walk away with some practical strategies to really tackle the current economic situation and landscape we're all facing. Hi, Gary. Thanks for saying hello. So first of all, I'd like to welcome and give the opportunity for a quick introduction. Firstly, Jarek Kovačar. Jarek is the senior economist from BankSA, and Daniel Rikiki, the accounting and business advisory associate at Hood Sweeney. First of all, you all might be a little bit familiar with Jarek, as he was one of our presenters at this year's tourism conference. So it's great to have you back on board again, Jarek. Could you just provide a little bit of information about yourself and your role at BankSA?
Yeah, sure. Thank you very much, Kathy, and thank you very much as well for having me today on this session. As Kathy mentioned, so I'm a senior economist with the Westpac Group, representing a range of the different brands for the Westpac Group, and of course BankSA as well. And as part of my role, I do a lot of analysis and reporting on the Australian economy, but also what's going on internationally as well, and how it impacts the Australian economy and the outlook for economic growth and economic activity from that macro perspective as well. And I've been in the role for a bit over 2 years now. And prior to that, I actually worked for the Commonwealth Treasury in Canberra for around 8.5 years. So I have a range of experiences there as well, looking at both economic policy making, but also macroeconomic analysis as well.
Great, thanks, Jarek. And Dan, can you just provide us a quick intro to you, please?
Yeah, of course. Thanks, Kathy, and hello to everyone online here today. So I'm an associate here at Hood Sweeney in the Accounting and Business Advisory Service. Hood Sweeney's a SA-based firm. Our main office is here on South Terrace in the CBD, but we also have regional offices around SA. So we're in Whyalla and Clare and Burra and also Kadina. We've been working together with TiCSA for many years now, being a preferred provider and supporting members since 2019. A couple of sessions we've done lately is about data security and risks in the technology area, and we also did a session in the SA Tourism Conference on succession planning. So yeah, a bit of a wide range of skills. In terms of myself, I've been at Hood Sweeney for just over 10 years now, and specialize in supporting small and medium-sized businesses, specifically in tourism and hospitality and food and beverage. Also do a lot of work with cloud programs and making the most of the tools that are available, which is definitely a key consideration in managing cash flow and the rising costs at the moment, of which, yeah, we'll be discussing a bit later on.
Great. Thanks, Daniel. You stole my thunder a little bit there. I was just going to wrap up to say, yes, Hood Sweeney have been a valued partner of TiCSA, and Dan too has been a familiar face amongst our community. Had the pleasure of being involved in our tourism conference as well this year. So moving ahead, we've recently had our April to June quarter barometer report released, and that really showed the environment of rapidly rising operational costs, interest rate rises, and wages not keeping pace are all starting to make a cumulative impact on businesses. So to get us into the headspace of the current economic landscape, Yarrick, I want to hand it over to you to kickstart us off.
No worries. Thank you very much, Kathy, for that. So I'll give a brief overview. I'll speak for about 5 to 10 minutes or so to give a brief update on what we're seeing with regards to the key economic indicators over the last few months. So I'll start off with sharing some slides. So if everyone can just confirm that they can see the slideshow, that would be great.
Yes, yep. I can see it. Thank you. Yeah, okay, great. Got a few thumbs up there. Perfect.
Excellent. So as Kathy mentioned, so I did give a more detailed economic presentation at the conference a couple of months ago. So I'm not going to go through everything in a lot of detail. I'm really just looking to touch on the most important pieces of data that we've received for the Australian economy over the last couple of months, which are really relating to inflation in the economy and what's happening there and what that might mean for Reserve Bank policy settings, and also for the labour market as well, given that we've received some updates there as well. So I think those are the two key factors that I'll talk about, but I'll also touch a little bit on just what we've been seeing with the general recovery in the tourism sector as well, and recovery with short-term visitor arrivals, for example. But really moving to the first key point, which is the inflation story and the inflation outlook for Australia. What we've seen in the most recent data, which is for the June quarter, is that the disinflationary process that's been underway globally for quite some time is now firmly underway in Australia as well. And this is a really positive sign, and it's really good news that we're seeing inflation starting to recede. And in fact, inflation in the June quarter actually came in a little bit weaker than was expected by financial markets and most economists, and also by the RBA as well. So we did see inflation at a headline level slow to 6%. Over the year to the June quarter, and underlying inflation, which does strip out some of the more volatile components and which the RBA looks at quite closely, that slowed to 5.9% over the year to the June quarter. So again, this is a real positive sign, and it's a pretty significant reduction already from the peaks that we saw, which were back in the December quarter of last year, when inflation peaked at 7.8% in headline terms and 6.9% in underlying terms. So that's the good news, that we are seeing that process happening, and it's happening perhaps a little bit quicker than expected. But the challenging news, of course, is that there's still quite a long way to go. Of course, with inflation running at 6%, it's still double the top of the RBA's 2 to 3% band. And we did also see the process that's been underway overseas, where services inflation has been a bit stickier. That's also playing out a little bit in Australia. So we saw goods inflation pull back to a bit under 6%, which is really positive, but services inflation actually accelerated to the highest level in in many decades, actually the highest level since 2001 at 6.3%. So we can see that on the left-hand side chart. So that's really going to be the area to watch going forward. We know that goods inflation will continue to subside as supply chain disruptions ease and as commodity prices are pulled back. But really, it's the services part of the economy that's going to be the concern, perhaps, for the RBA. Now, the good news, though, is that if we look at the quarter-on-quarter data, there is a trend of slowing inflationary pressures. So that's good to see, and we will need to see that happening over coming quarters as well. If we look at the tourism sector more specifically, and we dig into a little bit of detail there, we can see that there's been quite a lot of volatility, particularly around domestic and international holiday travel and accommodation over the last year or so. And this volatility has been extremely significant, with price increases rising, or prices rising in the double digits, not just on an annual basis, but even on a quarterly basis as borders opened up again and, of course, travel restarted. Now, we are still continuing to see quite a bit of volatility there, but it is easing a little bit, which is a positive sign, and it's likely to continue to ease going forward as well. So in the quarter, we did see domestic holiday travel and accommodation prices actually pull back, given that there were some discounting in airfares, and accommodation prices also pulled back. But on the other hand, we actually saw international holiday travel and accommodation prices rise, and that really reflected people traveling to Europe during the peak season. So that's going to be an area to watch going forward as well. So what does this all mean for the RBA? Well, what it does mean is that it is likely that the RBA may have reached a peak in interest rates. So the cash rate is currently 4.1%, and it is working to slow demand in the economy. Going forward, we actually expect this now to be the peak in the cash rate cycle. And if we look at what financial markets are pricing, they're broadly in alignment as well. So financial markets have about a 30 to 40% chance of one more hike in this cycle, but they are largely thinking that we're probably done with regards to interest rate hikes. So as I mentioned, that is our view as well. We think that there might be a risk of one more, but we would say the base case is that the RBA stays on hold from here on in. But it is likely that interest rates will need to be on hold for some time to really get inflation down and inflationary pressures down. So we're not expecting interest rates to be cut until late next year, likely in the September quarter of next year, but perhaps actually it might even be further than that. And again, financial markets are broadly in agreement there as well, and don't expect cuts until 2025. If we look at the employment situation, what we've seen is that the labour market still remains incredibly tight in Australia, but there are some signs that that easing that we've been expecting is starting to emerge. We will need to wait for a few more months of data before we can confirm that this is happening, because there is some volatility that's happened in the latest data. And in particular, the latest data was collected during school holiday periods, which does introduce a bit of volatility into the information that the ABS collects. But the broad theme is that we are starting to see the unemployment rate increase a bit. We saw that rise in the latest data from 3.5% nationally to 3.7%. And we did see the unemployment rate running at about 4%. But you can see how low it still is relative to history in that left-hand side chart. With regards to other measures of labour market demand, we are seeing those continuing to ease. We're seeing job vacancies pull back a little bit, and job ads also pull back. But again, relative to history, they're still at incredibly elevated levels. So still signaling that there's a lot of tightness in the labour market. There is still a lot of demand for labour, but it's just not quite as significant as it was before. We do expect that to gradually continue, and we do expect the unemployment rate to gradually rise from here on in. But it's more likely to be a 2024 story. So we do expect a gradual rise into the sort of the high threes this year. And then next year, we expect the unemployment rate to rise into the mid to high fours as economic growth really significantly slows in 2024. If we just look briefly at what's going on with visitor arrivals before we turn to some questions and discussion, we are seeing that the rebound in short-term visitor arrivals is continuing in Australia. And that's, of course, a positive sign for the tourism sector in general. We've been seeing this trend playing out for a number of months now. And if anything, South Australia is actually running a little bit ahead of the rest of the nation, with visitor arrivals sort of returning back to pre-pandemic levels a little bit more quickly. But as you can see on both of these charts, we're still not quite back at pre-pandemic levels yet. So it will take a little bit more time before we recover back to those pre-pandemic levels and actually grow beyond that point. But it is moving in the right direction. And what we're also seeing is, if we think about travel, exports and imports more generally, again, that recovery is underway. And we're actually seeing that travel exports are recovering more quickly than travel imports. So basically, we've got more tourists coming to Australia and spending money here than we have Australians going overseas. And this is partly due to what is going on with regards to interest rate increases. Of course, we know as budgetary pressures increase, as rates rise, people do put off more discretionary expenditure, such as overseas holidays, and are more likely to spend domestically. So as a result, we're seeing that the recovery in tourism imports, so basically, people traveling overseas, is starting to stall a little bit, while the recovery in exports is still continuing. But as I mentioned before, it's still likely to take a few more quarters before we really get back to where we were pre-pandemic. So I'll just stop there and just put up the obligatory disclaimer slide as well, and just move to just discussion with both Kathy and then the rest of the group as well.
Yeah, thanks, Jarek. I really thank you so much for providing that scene setting. Find that really incredibly interesting. Now, everyone, feel free to make the most of this wonderful expertise we have on the line with Jarek. So if you've got any questions, type them into the chat function. But I might just kickstart it off. So obviously we know interest rates, obviously we've been through this period of interest rates rises. We had a hold recently. And we know it obviously still takes some time for that interest rate rise to flow on to the consumer. We all know it if we're mortgage holders ourselves. So, you know, how does then interest rates generally affect that consumer behaviour in in tourism? We know obviously tourism sits in that discretionary spending. Are we really seeing that in the South Australian market at the moment?
Yeah, Kathy, it's a good question. So, so I guess as you sort of alluded to, discretionary spend is really an area that households do tend to pull back on first, prior to pulling back on other types of expenditure. But I think one of the key points here is that at a macro level, this picture is always quite complicated because there's always so many different things going on at the same time. So one thing we do see with regards to behavioral change is as budgets come under pressure, people do look to substitute as well. People don't want to necessarily completely get rid of a particular type of expenditure in their life. Obviously, recreation, is quite positive, and we all love to go on holidays when we can. So people do look to substitute and maybe holiday more domestically rather than going overseas, and look to go to cheaper regions and sort of change the types of holidays that they're having as well. So that's one of the reasons why you're seeing that that behavior that I mentioned before, where tourism imports are actually starting to stall as people look to reduce their spending on international holidays. One of the other ways you can look at some of this stuff is we can also look at spending from the retail trade surveys, which isn't a direct link to tourism, but we know, of course, tourism businesses are impacted by different types of spending, and of course, tourism businesses are across a range of different industries as well. So we can see spending on cafes, restaurants, and takeaway services, for example, is one more real-time indicator that we do get on discretionary spending, and we're seeing that starting to slow, not just in Australia, but in SA as well, although SA is running a little bit ahead of the rest of the country. Another way we can also look at this is to look at how much people are spending on domestic trips that they're making into the state on average. So we can see that on the right-hand side chart, where the average overnight trip spend did increase quite significantly during 2022, of course, on the back of really elevated inflationary pressures. But in the last few months, we've seen that 6-month average, that rolling 6-month average, start to plateau and start to pull back a little bit. So this might also be a sign that people are looking to economize where they can. Another way you can think about this is to look at different industries and how those industries are doing, and how they're feeling as well, but both of the conditions and the confidence with those industries. So we do get a monthly business survey that we can have a look at, and we can see that confidence across a range of industries is starting to pull back, while conditions are actually still holding up relatively well. And if you look at this by industry, it's really the retail trade industry where confidence is the weakest, even though conditions are actually still quite good. But if I'll point out here, the recreation industry, it's actually still doing relatively well. We can see that confidence is actually still above average. And even though conditions are below average, they're still quite positive as well. So again, these signs, we're seeing them show up in the data, but they're not quite there yet. So it's more of an expectation for things to continue to slow over the next 6 to 12 months for the industry.
Yeah, absolutely. I appreciate you sharing that, Yarrick, because it's pleasing signs for our state compared to other states, and we're starting to see the impact, but there's still some headwinds to come. But what I think we've also starting to see, and what we reported through our barometer, is now they're increasing yields, and which is as a result of businesses increasing, their prices, which is a case of they've just been faced with. But this is actually really pushing up where our visitor expenditure is sitting, and we've now eclipsed $9 billion in a visitor expenditure. So that's surpassing pre-COVID levels. So I think, to Paul, to your point, is people will look just to be spending smarter, Yarrick, and rather than still not wanting to give up all the obviously luxuries of travel, but wanting to spend smarter and be looking to those more domestic intrastate. Got to slow down there a little bit. Trips rather than the overseas side of things. Also, we have seen airport passengers continually increase, which is really positive in light of their current economic pressures, and shows that the demonstrating the recovery of the interstate and international markets as well. Does anybody have any questions? Oh yes, we have got one here. Thanks, Elaine. Elaine's popped a great question up here. What insights can you provide? Sorry, I'm just reading this quickly. What insights can you provide on business confidence in the services sector? Are there differences between businesses that are more focused on B2B than focused on sales to consumers? Can this be relevant for the business events sector as an opportunity? Look, I feel like we've kind of covered that a little bit. Yarrick, do you agree in that the screen you've actually got up at the moment?
Yeah, I think this particular chart is probably the most relevant to this question. Obviously, it doesn't break down B2B and B2C within these particular industries, but I think there are some industries that are inherently B2B versus B2C, and I guess you could see that with regards to retail trade and wholesale trade, where you can see the confidence in the retail trade industry is still quite negative, whereas in wholesale trade, confidence and conditions are actually still quite positive there as well. So we do know that the supply chain is quite complicated. So of course, different aspects of supply and demand will take some time to flow through the supply chains. We know the wholesale trade industry and many B2B businesses were heavily impacted by increases in input costs, such as, of course, not just commodity prices rising, but the supply chain disruptions that we saw during the pandemic. And now those have been easing. So you would expect that that's helping margins for a lot of those businesses, because they've, of course, looked to pass those costs through into their prices, and now they're seeing their input costs start to come down. So that will sort of help those businesses. Whereas, of course, on the demand side, we're seeing that consumer demand is starting to slow, and that will first hit your retail sectors and your B2C B2C businesses before it eventually flows through and hits those B2B businesses as well. So I think there are these lags in the transmission mechanism throughout the supply chain. But as we do expect consumer spending to slow quite materially and to really be the driver of the economic slowdown, eventually you would expect that to first flow through to businesses that are more exposed to consumers, and then start flowing through to those businesses further up the supply chain as well.
Yeah, sure. No, very, very good points there, Yarrick. Matthew from Small Match Wine Tours has raised a good point regarding the Australian dollar. Does it look like what's your insights around the dollar, Yarrick? Do you think it's going to remain competitively low for the next few years? You know, and will that help Australia as in terms of affordability as a travel destination?
Yeah, that's right. We've seen some quite significant moves in the Aussie, particularly in the last couple of weeks. And there's been a number of things that have been driving the weakness that we're seeing. You know, when you think about currencies, there are three sort of key themes that you like to think about, which are interest rate differentials, risk sentiment, and also differentials within economic conditions in those underlying economies as well. So if we think about interest rate differentials, that's been quite negative for the Aussie. We've seen that the RBA is now looking like it's likely to have stopped raising rates, whereas we may still see some further rate increases in other economies. So that's placing some downward pressure from an interest rate perspective. And of course, there is this differential as well, where you know, the US dollar, as an example, yields more than the Aussie does. So that does place downward pressure on the Aussie dollar in the near term. But on top of that, we've seen economic data be a bit weaker than expected in Australia. I did mention that the unemployment rate was a little bit higher than we expected. Wages growth was also a bit slower than expected in the most recent data release. While in the US, we're seeing economic data actually surprising to the upside. Now, overnight, we did see some downside surprises in Europe in particular and the UK. So that's you know, a bit of a mixed picture there. But that story is also placing a bit of downward pressure on the Aussie. And of course, the Chinese situation has really been the other key weight in the near term, with the Chinese economy under a fair bit of pressure, and it being quite uncertain what sort of stimulus the authorities will provide there. I mean, going forward, I think there will be probably quite a bit of volatility in the next few weeks and months, particularly given what's happening in China. There's been a large amount of expectations that China will stimulate the economy pretty significantly, both with monetary and fiscal stimulus, but those expectations haven't really been realized. We have seen some monetary stimulus, but on the fiscal side, I guess investors have sort of been left wanting. And on top of that, there are some other concerns that are emerging out of China with some of the property developers, you know, having some issues. So we're seeing some of these issues that affected Evergrande a couple of years ago kind of re-emerging. So I think there will be some volatility in the near term, but longer term, we are expecting the Aussie to gradually rise as the US dollar gradually falls. So eventually, once the US gets there, gets on top of inflation, the interest rate differential situation should mean that interest rate differentials will be less negative for Australia as the US eventually starts cutting rates sometime in 2024, but we do expect it to take longer for the RBA to start cutting rates. So once you see rates coming down there, but not here, that will narrow those interest rate differentials and will support the Aussie. But on top of that, we do expect growth in the Asian region to still be pretty robust, although, as I mentioned, there are quite a bit of question marks around China and around how that will play out. But if the baseline story does play out and the Asian region outperforms North America and Europe, that should also support the Aussie as well. But those are more sort of longer term themes, I guess, going into the end of this year and then really through next year. I would say for at least the next few weeks, months, and probably a couple of quarters, you probably see a bit of volatility around these levels before those baseline trends of a more strengthening dollar sort of kick in, I think, around next year sometime.
Yeah, sure. And Yarrick, obviously the word gets thrown around a little bit given the current economic state and the volatility you mentioned of the markets. You know, recession, what's your thoughts? Long term, are we probably going to see Australia head into a recession? You know, I think there's some, like you said, I feel like there's still some things to play out with the Asian market, and that could outperform other markets for us. But what's your sort of indicators suggesting? in relation to a recession?
Yeah, so we don't have a recession as our base case. We do expect the economy to continue to grow, but we expect growth to be quite weak, being well under 1% this year and a little bit so a bit under 1.5% next year. So that's definitely a lot lower than the long-term average, which is around 2.5% for the economy. So we are expecting growth to be quite weak, but not to go through a recession. But I think one important point to make here is that, of course, the population has been growing at record levels. So that is expected to support aggregate economic growth. If you actually take out the population, we do expect growth per capita to be recessionary throughout 23 and 24. So we're actually expecting a pretty prolonged per capita recession. But in aggregate, we are expecting that that the population growth numbers will effectively mean that the aggregate economy will continue to grow, even though per person we will see a per capita recession. So it is going to be a challenging period for many people, where it will definitely feel like a recession for individuals and households and families because of those per capita numbers. But in an aggregate sense, and to some degree what businesses are seeing as well, that will be held up by really strong population growth.
Yeah. All right. Great. Thank you, Yarrick. You've provided a really good insight and scene setting for us, and I really appreciate that. And I hope and grateful that for the people who have interacted through questions. Yarrick's going to stay on, so please feel free to continue if you have any questions. To continue to pop them in the chat. We can circle back to them at the end. But obviously, we know now this environment of rising costs is transitioning into cash flow management being a major issue for tourism businesses. Interest rates have escalated and inflation have remained high. Wages have grown at a much lower rate. So therefore, this really does affect that disposable income, which our sector's really relying on. And I feel like after a really volatile couple of years that our industry has faced, there's a new wave of challenges facing our industry. And Daniel, I'd be keen to hand over to you now for you to provide, just to start off with, really probably a quick refresher on the importance of cash flow forecasting, and then perhaps we can dig a little bit deeper.
Yeah, absolutely. Thanks for getting me in. So following on from Yarrick's comments, I guess, the economy is getting pushed and pulled in 1,000 different directions at the moment, and it's putting strain on everyone's financial situation. So we're finding that there's businesses out there, which I'm sure includes a few of you guys here today as well, are under pressure to keep up with payments such as electricity rising pretty quickly, rental increases as well, so lease increases, and then even employee award updates, which is pretty big. It all adds up. Tourism being even more volatile to external factors, like was just mentioned, including the economy and travel and labour shortages. It is critical for businesses to understand their cash position now, but also in the future, to be able to push forward and be successful. Look, just to start off with a couple of important considerations to run through before we get into some questions with Kathy. So the first one being, profit doesn't always equal cash flow. So I'm sure many of you have asked, why your bank account balance doesn't necessarily show the same figure as your net profit. Sales and expenses are not only the only ways that cash will move in and out of the business. We need to consider balance sheet items like taxes and loan repayments and even personal drawings out of the business, because even profitable businesses can have cash flow issues as a result of this. The second one being that timing is absolutely critical to keeping on top of payments. When income is predictable and expenses are expected, sure, it makes it much easier to control the flow of funds. However, when facing badly timed payments that come up or unexpected issues, this can put you back a few steps, and having a future outlook here is pretty important. The third one, negative cash flow isn't always a bad thing. So before you panic about your situation, just have a think about it in full. Negative cash flow may have been due to investing in growth or products, and cause a bit of strain that way. Always weigh up, if the operating, if it was operating cash flow from sales and expenses versus investment or finance cash flow problems. They could tell different stories about what's actually happening within your business there. And the fourth one is the difference between a budget and a forecast. So hopefully you've been exposed to one or both of these within your businesses, but these two functions allow for businesses to look forward into the future as opposed to look in the past or even looking at the here and now. However, they are different. A budget is developed in advance, usually for a full financial year, and sets the goalpost for what needs to be achieved to get a desired result. Ordinarily, this aims to either achieve a net profit, or in this scenario that we're talking about, maintain a positive cash flow, as opposed to a forecast, which still looks at the future, but has much more of a short-term, accurate expectation based upon how the business is actually doing right now. Both of these tools are key in visualizing how to deal with the impact on cash flow in the future. So yeah, just covering off on those four. Happy to jump into some questions, Kathy, and you can get into a bit more detail there.
Yeah, absolutely. Thanks. I think you've made some really good points there, Daniel. So I think probably it's about, looking at key performance indicators that we should be monitoring to assess, that cash flow of our business, and obviously really understanding that profit doesn't equal cash, and particularly your point around cash flow isn't always negative, because it could be based on you could some really solid assets there as well. So I'd be keen to sort of unpick a little bit more around any key KPIs that we should be using top of mind to assess that sort of cash flow health as such.
Yeah, absolutely. There are many KPIs, so and can get a bit confusing. If you search it online or have any experiences, there's quite a few to choose from. But ultimately, this will depend on the size of your business and also the financial data that's available. So it's important to pick the right cash flow KPIs for you and stick to your business goals. Right. So if you just want to get slide 2 up there, Laura, if that's okay, we recommend considering the following criteria in order to choose those KPIs.
Sure.
Yeah, that's
thanks, Laura.
Great, thank you. Sorry, I should have mentioned the first one. But yes, this is just a couple of considerations here. So the first one is to make sure you have a mix of financial and non-financial measures. So almost all financial indicators will come either from your balance sheet or from a cash flow statement. And this is a great place to start, basically. Examples are just your operating cash flow from a cash flow statement. Very simple way of understanding exactly where you are. Or even using something like a current ratio, a quick ratio, which is just looking at your how quickly you can cover your debts with your assets. I'm not going to go into too much detailed explanation of what each ratio means, but the point here is basically insight can actually come from non-financial factors as well. So things like customer satisfaction and number of visits and bookings is going to be really important, because this can help guide your expectations of the upcoming cash flow that's there. The second one being using leading and lagging KPI measures. So basically looking backwards, but also looking forwards. Reviewing last month's figures can tell you why your cash flow is struggling, which is got to paint the picture of where your cash flow position is at. But in looking forward with measures such as how long debtors take to pay their invoices, they may not be sticking to your terms, especially in the market at the moment. You can have a bit more realistic expectation when those funds will actually hit your bank account. The third one is using trend and benchmarking data. So this is something that's become very requested in my client base and in the industry at the moment. This sort of data will allow you to compare your results with other similar businesses within the tourism industry. and see where your business is either ahead or behind or even on par with expectations. And what it does is it highlights areas with opportunity to improve. So there's data out there that we can access and compare against your business. And the fourth one is leveraging software solutions. So accounting programs such as Xero is there to make bookkeeping simple, making it easy to be on top of your accounts and having them up to date. And the important thing here is that financial KPIs feed off of this real-time data and can give you immediate insights if that's all up to date and accurate. We'll explore this a bit later with some of the other questions, but it's definitely a priority to have the appropriate software programs in place to report on these KPIs going forward.
And I'm sure, you know, by having the right tools there in terms of software, it allows you to dig deeper and get a true, in real time, you know, indication of where you're positioned as well. And then historically, you know, I'm sure that's really valuable as well when you can pull on, you know, that information as well. Daniel, common cash flow issues that businesses face, you know, what are the common pieces that businesses are facing?
Yeah, I'll jump into that. Laura, you can pull that slide down now if you like. Thank you. No other slide for this one. So probably the most common challenge that we come across that businesses are facing is having cash flow available for the ATO payments. That's the biggest thing. And that doesn't matter if you're a small business as a sole trader all the way up to a big business. The ATO payments are something that really stick out. With BASs usually being lodged on a quarterly basis, it could be sidelined. So other payments seem to take precedence from a week-to-week basis, especially when suppliers are for your goods and services that you actually sell to your customers. Their payment due dates are shorter, you know, 7 days, 14 days, or, you know, 30. They're in your face as well, and you need to pay them to be able to make your next sale. So by the time the BAS comes round, the funds simply aren't there. So I'm not sure if you guys have experienced that as well.
Yeah. So what are some of the little strategies that you can provide for a business to go, yes, we know, you've got those smaller windows for payment of accounts and invoices, typically 7, 14, 1 month. And then obviously, we've got to be, not lose sight that, quarterly tax bill's going to come. What are some of the strategies that you're employing to support businesses to obviously manage that short term, but also make sure there is that funds there for the long term as well?
Yeah, absolutely. It's a case of everyone's going to be looking at their bank account at the moment and knowing what they can pay within the week or the day, but it's having the foresight of putting the funds aside to be able to deal with those larger payments that do come up on a quarterly basis, or having those funds there for unexpected payments that come up. So I mean, this can be managed with a secondary bank account that's put aside. So if we're talking purely, for an example, for the ATO, a secondary bank accounts usually don't cost any extra, if not much, to have open within the business, and make sure that you're putting money aside for GST and PAYG withholding and income tax installments. It's a pretty old trick, so I'm not making this up. It's been around for a while, but I guess the important thing here is to stick to it. For example, for those of you with wages, if you're paying a pay run, then immediately pay the PAYG withholding from that pay run across to this account. For those that are registered for GST, making sure that you have a percentage of your sales calculated at the end of the week and putting that money aside into this bank account. There's also reports and stuff in Xero and other accounts that can give you this sort of indication.
It's about being really strict on yourself, essentially, isn't it? Keeping yourself accountable and really being strict in forming those really healthy cash flow management strategies to support you through. And probably something I just take away out of it is it's also making sure you're forecasting. A lot of people forecast revenue, but making sure you're forecasting your expenses as well, so you keep ahead of the game, sort of thing. What's coming.
Absolutely. And giving yourself that opportunity to react when you have to, because there will be invoices that you don't expect, and large ones that you don't expect. So yeah, having that sort of foresight lets you be a bit more ahead of the curve in terms of what's coming up that's bigger down the line.
So how often should we be reviewing like forecasts and our, cash flow sort of strategies we have in place, given the current situation? We're talking about developing some really healthy habits and making sure we're forecasting not just revenue, but also expenses as well. How often should we be reviewing? Is that something, again, I feel like this forms part of some really healthy habits we should be keeping ourselves accountable to?
Yeah. Yep. Oh, look, there's no doubt that, especially at the moment, most business owners are looking at the bank account every day. So I think that's, we don't want to have to be doing that. But in situations and in the economy as it is, it's a good idea to be doing that. But I guess what we want to be doing is reviewing the cash position and forecasting the future cash position pretty regularly. Weekly check-ins, at least, I would have thought, and making sure that doesn't need to be a full meeting or full discussion, but a weekly check-in to see what your cash position is at the moment and what the short-term forecast is looking like. And then on a monthly basis, making sure that where you've been is aligning to where you're going. So perhaps, creating a budget and sticking to those figures will allow you to keep those margins and keep the funds coming in.
Yeah, exactly.
And
I
also,
get that's, oh, sorry.
I was just going to say also, it doesn't need to be just in the times where cash flow is hard to come across by. It's also good to have these check-ins and reviews while cash flow is good or while performance is good, because that's a really good opportunity to be able to take advantage of the times where you've got a little bit of extra cash or a little bit of extra performance that's coming through the business, and use those times to put some cash aside or to spend on growth and to spend on development or marketing when you've got that. So not only having these discussions in the times that are tough, having the check-ins and that sort of thing as when times are good too.
Yeah, exactly. And, I understand this is a challenge that many of our businesses face because, our business owners are busy running the business, and working the business. And there's, to work on the business and work in the business are two different things. And, this is where we really encourage, we've got a valued partnership with Hood Sweeney to reach out and utilize the expertise, having another set of eyes on the end game for you helps keep you accountable as well. Dan, I just want to circle back to a point of talking about technology and software tools, and how they can be really helpful for businesses. As we talk about, many of our operators are busy working in their business and on the business. So it's about working smarter. And I think working smarter is about using some amazing resources you can have at your fingertips in software and technology. But understandably, sometimes we can get overwhelmed by change, as well as, perceived ideas that these can be really costly as well. What software tools are there out there? How can you debunk some of those myths for us, Daniel, and how effective really are they?
Yeah, that's a good point, Kathy, especially about the point of trying to work on the business rather than the business. That's something that we've been trying to work with our clients over many years to be able to shift that mindset. And software technology has really increased over the last 5 to 10 years. Since I got into the industry of accounting and business advisory, I've been lucky enough to sort of grow with it. So I've got a good understanding and understand that change in terms of the processes and software can be a bit overwhelming. But yeah, I'm sure that it's definitely a good idea. But I guess in terms of talking about cash flow and forecasting and that sort of thing, we can start off with the simplest and probably most cost-effective way to lean on software, which is your accounting system. because your accounting system is so much more than just that. Practically is your business. It reflects the business in so many different ways, and it gives insights as to the data that's available. So I'm a pretty big advocate of Xero. However, I do understand some businesses have alternatives or different requirements for specific systems. So it just depends on what's necessary. But Xero usually can either deal with it or deal with it with add-on programs. So for example, bookings can add into Xero. There's wet considerations for wineries. There's online sales, all that sort of thing. But I will just sort of talk to Xero specifically for the moment. But as long as you have accurate and regularly updated accounts, you can get a lot out of it. Business owners can do this themselves, so you guys can do this. Or if you've got a bookkeeper, then having them do and keep your things up to date would be great. Or you can have outsourced finance, 1 or 2 days a week. But basically, the better the data going into your accounting system, the better the reporting is going to be coming out of it. So within Xero, there's things like a simple report called a cash summary. I actually had a few clients that didn't even realize it was there. But this shows account by account where your money is going and coming in from. If all bank accounts are live and within Xero, then there's no hiding where the money could have been spent. So that's really good. And Xero's also just introduced some free analytics about short-term cash flow. So it gives you a really nice dashboard about how your upcoming bills and your upcoming sales are going to impact your cash. So yeah, that's a really good way to do it. There's also other programs that can link into Xero that we use. So we use one called Futurely, which allows data to be brought in and forecasting out a position and looking down the path of 6 to 12 months. You can build a budget for your financial year out of it, using the data from Xero and some different assumptions there. And there's another program that we use called Fathom, and that brings Xero data across, and it formats it in a way that's much more visual as opposed to just a whole bunch of numbers. This is a great tool to monitor KPIs, like we were talking about before, both financial and non-financial, but comparing trends and using traffic light reporting to just make it easier to understand actually what's happening in the business. So look, I'm a big advocate for software programs. There is a cost to it, but as long as the value you're getting out of it is outweighing that cost in terms of time saving or data available, it's definitely worth it.
And I think to your point, Daniel, like these can integrate with existing platforms you're using, if that's through your booking systems and various other platforms, depending on the business you have. So it's really about making it smarter, using the resources to work smarter and more effectively for you. Dan, I'm conscious about time. So as we finish up, can you fire off some really top 5 like tips and tricks, what we should be doing given this economic climate we sit in? What should we be doing? What should people on this session today and those watching afterwards, they should be walking away and doing once they've watched this webinar?
Yep, sure. Laura, if you just want to just grab that last slide up, please, that'd be great. So we've just put together 5 points, just based around sort of what we've discussed today and a couple of other factors that are going to come into it from a software or business perspective. So just that last slide. So number 1, report on relevant KPIs. So to what we were speaking about before, key performance indicators. Find out what indicators work for your business and keep them front of mind with regular reporting that's easy to understand. So, these KPIs are important, but as long as you understand them, then that's how you're going to get the value out of them. So have a structured report around that, and you can get some assistance from your accountant or from someone to view that or know where to get the data from. Number 2 is lean on the software tools and the technology. Like I mentioned before, each program that you sign up to, each software you sign up to is another subscription cost. But from my experience, in most cases, the value of that program can far outweigh its cost. If that can, like I said, if that can take time in your day and give you back some time, or if it can just add value to you understand your business, that's going to be really, really key. 3 and 4 a little bit more about future and using the data that's at hand. So number 3, prepare an annual budget for 2024. It's not too late. It's a little bit, but it could still work. We're only 2 months into the year, so preparing an annual budget really gives you an ability to set your goalposts for the year and hold the business accountable to maintaining its margins and its positive performance. So it's a really good way in integrating with the reporting. Number 4, monitor your short-term forecast. So like we said at the beginning of the discussion, if you have foresight on any difficult periods with cash flow, this will give you time to be agile and to adjust to the conditions. So if you do have that 1 month, 3 month look down the road, you can plan for it where cash does become a problem. And number 5, don't hesitate to ask for help. Whether it's a business that you're close with, or your accountant, or an advisor. From our perspective as accountants and advisors, it's our role to understand and teach business owners about managing cash flow and forecasting ahead. So as part of this session, we're more than happy to offer anyone online today, a 30-minute phone call with either myself or someone else within Hood Sweeney, just to give a bit of direction and guidance about what we've spoken about and just how to really make the most of what you've got in your business and monitor that cash flow.
Yeah, thank you, Daniel. I think that's a really good point. We all can't be experts in every part of our business. So it's really important to engage the right people where you need the help in your business. And usually the worst thing you can do is not ask for help. Before I wrap this up, is there anybody who has any questions for Daniel on the line? I feel like you've really covered it comprehensively there, Daniel, and thank you guys. I probably, as we wrap up this, a big thank you to Jarek and Daniel from setting the scene, Jarek setting the scene and really giving us an update on the economy and how it's getting really pushed and pulled and what that looks like for the short term and possibly further insight to those headwinds we're certainly facing, at least for the next 12 months. And my key takeaway from Daniel is making sure we're really well positioned in our business to face those headwinds, because they're just, we're probably, what we're reporting from the end of the June quarter, they're just starting to hit us, and we know our industry is challenging and it is volatile. We've had a really rough trot over the last 3 to 4 years. So I'd like to thank Daniel very much for that generous offer of a 30-minute consult. That's probably the thing you can't, just ask for help, and he can even go over a little bit more in depth about those really top tips and tricks which we've talked about, looking at the KPIs, looking at your software, working smarter, not harder. What's your budget? If you don't have a budget, we're 2 months in, let's get a jump start on it and at least keep our eyes on the road for the rest of the financial year. And then, like Dan said, about just making sure we're looking at our cash flow from a short-term aspect. Those weekly check-ins and monthly check-ins help keep you accountable, but also help us make sure we're well positioned for the future. So thank you for that, Dan and Jarek. Guys, we'll link in Daniel's emails and that, and if any of you wish to take up that offer, it just starts with a chat. It's so easy too. So we'll link in those details to an email that you'll all receive post this session, as well as a recording. So I know myself, I'll always like to come back and rewatch things. So and I've just overlooked one last question that's come through as I've wrapped up. Thanks, Sandra.
I can answer that one, Kathy. I saw that come through really quickly, if you like.
Thanks, Dan.
Yep. So Xero's help function online is actually quite good. So the first point of call I would say is depending if you like reading or if you like watching and listening, they have some really good short videos, 1 minute, 2 minute, 30-second videos that just show what Xero does and how it works. Yeah, otherwise there's a whole bunch of articles very simply detailing what needs to happen. The thing about Xero is that it's built for a business owner as opposed for an accountant or bookkeeper. So the wording and the discussions and their help articles and guides are quite good. So start there as a first point of call. Second point of call is you're more than welcome to take up the half an hour offer, and I can show you a little bit around the place as well. So we've got demo access to files that may be of assistance as well.
Oh, perfect. Thank you, Daniel. Well, guys, we really appreciate everybody's participation. A big thank you to Yarrick and Daniel again for their time and expertise today. Thank you for you all attending. We really aim to make these sessions, you know, conversational, engaging, and want you to come out with some really tangible resources or ideas and tips and tricks, and to really continue to have your tool belt stacked of tools and resources to navigate you through business. Feel free to reach out if you need anything from me or any one of the TiCSA team. And I'd like to wish you all a wonderful day. Thank you. See you. Bye.